Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical and fundamental analysis. Today is November 23rd, 2025, and we are taking a deep dive into pound sterling to US dollar, also known as cable. We've got a lot to cover, from the latest news driving the market to a detailed breakdown of the charts. So let's get right into it. First, let's look at the fundamental landscape, which is being heavily influenced by diverging monetary policies between the UK and the US. The market is currently pricing in an 83% probability of a rate cut from the Bank of England as soon as December. This dovish sentiment is fueled by expectations of slowing inflation in the UK, even though the recent CPI print at 3.6% was a bit hotter than anticipated. Conversely, the U.S. Federal Reserve is maintaining a more hawkish stance. While odds for a Fed rate cut in December have risen to around 55% after weaker jobless data, key officials remain cautious about easing policy prematurely. This difference in central bank outlook is creating yield differentials that naturally favor the U.S. dollar over the British pound. Adding to the pressure on sterling is significant uncertainty surrounding the UK's upcoming autumn budget, scheduled for November 26th. Analysts are flagging concerns over a substantial fiscal hole, estimated to be between 30 to 40 billion pounds. The market is anxiously waiting for a credible plan from Chancellor Rachel Reeves, and any failure to deliver could put UK assets, including the pound, under severe pressure. This fiscal anxiety has been described as the primary driver for the pound sterling to US dollar forecast right now. We are also seeing a broader risk-off sentiment in global markets, with weak GDP figures from Japan and Switzerland fueling slowdown fears. This has triggered a classic flight to safety, further boosting the appeal of the US dollar. News outlets have identified a critical battleground for cable right around the 1.3100 to 1.3140 area. They note that this zone, which previously acted as support, was breached earlier in November, and the pair has been struggling since. Now, let's bring up the charts to see how this news has translated into price action. We'll start with the daily chart for a long-term perspective. Looking back over the past year, we can see pound sterling to US dollar peaked in late September, reaching above the 1.37 level. Since that high, the pair has been in a clear and consistent downtrend. We saw a period of consolidation through October and early November, where the price seemed to find a floor. However, the bearish pressure has clearly intensified in recent weeks. Notice the sharp, decisive drop right here on November 19th. The price fell from a close of over 1.3146 down to below 1.3060 in a single day. This move aligns perfectly with the heightened concerns over the UK budget and the strengthening US dollar we just discussed. The price has since attempted a minor recovery, but is currently trading just below 1.3100 as of the last close on Friday. This level, around 1.31, is clearly a psychological point of interest. The previous support area around 1.3140 to 1.3150 has now flipped and is acting as immediate resistance. Any bullish attempt will need to decisively break and hold above this zone to gain traction. On the downside, the low of that November 19th candle, around 1.3042, serves as the most immediate support level. A break below that would open the door for a test of the major psychological support at 1.3000. Let's switch to the 1-hour chart to get a closer look at the recent action. Here we can really see the volatility from the past few days. Leading into the big drop, the price was chopping sideways in a tight range. Then, the selling pressure built up, leading to that waterfall decline. Since hitting the lows, the price has been consolidating in what looks like a bearish flag or pennant pattern. This is a continuation pattern, which suggests that the path of least resistance remains to the downside. The price has repeatedly tested the lower boundary of this consolidation near 1.3040. It has also failed multiple times to break above the upper trend line, which coincides with resistance around 1.3110 on this time frame. This coiling price action is typical before a significant news event like the upcoming UK budget. Traders are clearly hesitant to commit to a direction until more clarity is provided on the fiscal front. Now let's drill down to the 15-minute chart for the most immediate view. In the last couple of trading sessions, we can see the price is tightly range-bound. The volume has been relatively subdued, which further reinforces the idea of market indecision. We are seeing lower highs and higher lows, forming a tightening triangle pattern. A breakout from this short-term pattern could signal the next immediate move. A break below the triangle's support could see a quick drop to test the 1.3040 lows again. Conversely, a break above could see a retest of the hourly resistance near 1.3110. Day traders should watch for a volume-supported break of this pattern for potential entry signals. However, be cautious of false breakouts or fakeouts, given the low liquidity and pre-news environment. Let's go back to the daily chart for a moment and zoom in on this critical period from mid-November. I want to highlight the price action from November 12th to now. You can see the price breaking down from the 1.3150 area, with the bearish momentum accelerating significantly on the 19th. The large red candle on that day shows that sellers were in complete control. The following 2 days, the 20th and 21st, printed small doji-like candles. These represent indecision but are occurring after a strong down move, which can often precede another leg lower. This price action shows that while the selling has paused, buyers have not yet stepped in with any real conviction. This is the key battleground that the news articles were referring to. So, to recap the key levels we're watching. Immediate resistance is the old support zone of 1.3140 to 1.3150. A break above that would target 1.3200 and then 1.3250. Immediate support is the recent low around 1.3040. If that level breaks, we will be looking at the major psychological level of 1.3000 and potentially the August low of 1.2985. Now for some potential scenarios, keeping in mind the major event risk of the UK budget on November 26th. The bearish scenario seems most likely, given the fundamental headwinds. If the UK budget disappoints or the Fed minutes come out more hawkish than expected, a break below 1.3040 is highly probable. This could lead to a swift move toward 1.3000 or lower. I would place the likelihood of this scenario at around 65%. A bullish scenario would require a significant positive catalyst. This would most likely come from a surprisingly credible and market-friendly UK budget that alleviates fiscal fears. In this case, we could see a short squeeze, pushing the price back above 1.3150 and toward 1.3200. The likelihood for this feels lower, perhaps around 35%, as the broader trend and monetary policy divergence are strong bearish factors. It is also possible we see continued sideways consolidation between these key levels until the budget is released. The key thing to watch is the price reaction at the 1.3040 support and the 1.3150 resistance. A sustained break of either level will likely dictate the direction for the coming weeks. And finally, a quick disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. Always do your own research and consult with a qualified financial professional before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next video.